Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Leading Practices in Treasury podcast series. This 6-part series is based on the second ebook in the professional development series, also titled Leading Practices in Treasury, produced by Strategic Treasurer, a reputed treasury consulting company, and CTM File, a prominent corporate treasury news site. The ebook provides practical, focused recommendations and insights into several of the most vital areas of the treasury function. I encourage our audience to download the ebook or listen to the audiobook version by visiting strategictreasurer.com. Through this 6-part podcast series, we will explore the most essential topics covered in the ebook, Leading Practices in Treasury. In this episode, I, Pushpendra Mehta, your host, am joined by Paul Galloway, Senior Director of Advisory Services at Strategic Treasurer, to discuss the first topic in the series, Bank Relationship Management, or BRM. Welcome, Paul. It's wonderful to have you join us. Thank you for taking the time to provide your informed perspectives.
Yeah, thanks, Push. I appreciate being here again.
Paul, it's often said that the symbiotic relationship and enduring interdependence between banks and corporate treasury underscore just how essential effective bank relationship management is for treasury departments. So to begin, why are bank relationships so important to corporate treasury?
That's a good question, Push. These relationships help treasurers manage a variety of things within an organization. It used to be that managing the movement of cash was the primary function of treasury. The role has expanded significantly over the years. And so treasurers today are now focused on the overall capital health of an organization, the ability to have credit extended so that they have liquidity when they need it. Bank services have advanced quite a bit, and so we can think about the advent of payment security, in particular positive pay or pay match positive pay, these tools and services that banks offer so that they can protect the payments as they execute those. So payment security has become much more top of mind from a treasury perspective, and your banking relationships can help you manage that. The other area that probably is not looked at as often, but is also important, is access to markets. And so an example of that would be perhaps an insurance company that wants to sell a product through a bank's broker-dealer platform. Those relationships can be symbiotic. They sell services to the company, but the company can also sell product across the bank's platforms, which makes it symbiotic and allows that relationship to be even stronger. So bank relationships tend to be an area of focus that the treasurer is quite often focused on. At least quarterly, they're probably talking to the banks, perhaps more often if it's a bank relationship that is significant to the organization.
Thank you, Paul. That's a sound explanation of why these relationships serve as a cornerstone of treasury operations. Let's build on that. Is counterparty risk important in managing bank relationships?
Yeah, the counterparty risk is really important to organizations. It can't be overlooked. When you think about headline news from a couple of years ago, we had several banks in the U.S. that failed. So that counterparty risk is real. So an organization that is going to have a partnership with a bank, they need to take a look at the balance sheet, the health of the bank. What are they actually doing? Because the business of a bank is assets and liabilities, or in terms that banks typically look at, it's deposits and loans. So they get deposits, they make loans. So there's both sides of the coin that have to be managed there. They take those excess funds that they have and they invest them in a variety of products out there. And loans can be fairly safeguarded. Others can be perhaps more risky. The more risk-taking that a bank is taking on, that means that the balance sheet or the health of the balance sheet may not be as robust as one thinks. having access to that balance sheet is important to treasurers. That's the extension of credit. Perhaps it's a revolver or something else where it's a liquidity tool for a company. So understanding what that counterparty risk, I think, is important. So sometimes organizations may have more than one bank that they rely upon for not just banking services, but for credit, extension of capital, access to markets. The bank services are provided, you diversify, you have a little more insulation. So the ability of the bank to meet obligations and the stability of that balance sheet is really important.
Excellent insights, Paul. You've emphasized a vital aspect of bank relationship management that every treasury team should prioritize. Paul, you shed light on why bank relationships are so important to corporate treasury. Does this strength of the relationship between the Treasury Department and its bank matter?
Yeah, it does, definitely for some of the reasons I outlined in the prior two questions you asked. Banks do expect that deposits will be held with the bank when extending credit. So it's kind of that reciprocal concept that I talked about before. You work together. So if a bank is going to extend credit in particular, they are banking on, no pun intended, they're banking on that deposits are going to be within the accounts that you have at the bank. So you open accounts, you make deposits, you hold a certain level of funds there. This is how the bank makes money, because they take those deposits and they extend loans to other people or credit to other people. It could be individuals. It could be other companies that they're extending credit to. They make a return off of that. So the expectation is that a certain level of deposits will be maintained so that the bank can do the kind of business that they do. So when you think about that relationship, the strength of the relationship will matter. The stronger the relationship, the greater amount of credit they're going to extend to an organization. So strength can be really important.
Well said, Paul. Strong relationships, as you said, often lead to better outcomes, especially during times of uncertainty or rapid change. Now, moving into the financial aspect, what is share of wallet and does it hold importance in the context of BRM or bank relationship management?
Yeah, share of wallet is looking across the entire organization in terms of the relationships you have with banks. Exactly what kind of business are you doing with them? So it's more than just Treasury by itself. For certain organizations, they may do a lot of trading. Any organization that, would be like a non-bank financial, like an insurance company, for instance, that has a lot of assets on the books, they're going to do a lot of trading. Those assets back liabilities for products that they sell. So they're going to do a lot of trading. A lot of times there's also hedging involved. So anytime that you have trading and hedging and your counterparties are banks quite often, that's another relationship that you have. I talked about before the ability to sell product across bank broker-dealer platforms. It's another relationship that you have. Perhaps it's credit card payments. You have a corporate card that your employees utilize, so you have credit cards that are involved. That's another relationship that you have. So it goes on and on. There's more than just the bank accounts that you have from a treasury operating perspective. You got to look across the entire organization, as well as the amount of backing that a bank's going to give an organization from perspective of raising capital or extending credit in the form of perhaps a revolver, a credit facility for liquidity purposes. So it goes broader than Treasury by itself. You need to look at it in totality. So treasurers quite often will talk to other people within an organization to understand what those relationships are. Who are the banking partners that are important to the company? It may not be the same banks that you're doing a lot of business with from a treasury perspective or from a trading perspective, but maybe it's from that broker-dealer platform that you're utilizing. So you got to look across the entire board. Another area that isn't talked about too often, what I was talking about when it comes to capital and the use of capital, you can think of how organizations grow from either organic growth or acquisition. So it's the ability to reinvest capital into the business organically through new products, new services, or perhaps it's acquiring it through an M&A transaction. Oftentimes, banks provide services to help organizations with not only M&A transactions themselves, but also the way to capitalize it in a way that provides the kind of return that a company would want on any type of acquisition that they make.
Great point, Paul, for recommending Treasury teams conduct share of wallet calculations to proactively manage their bank relationships. Paul, let's turn to scorecard, another important aspect of BRM. What does a scorecard do in the context of bank relationship management?
This is an area that perhaps not all companies take time to focus on or execute on. Bank scorecards basically are a way to gauge the level of importance of the bank to a company. So we talked about those relationships and why they're important, the strength of them, and the ability to understand what share of wallet looks like. Part of that process is a scoring mechanism to put the level of importance to the bank relationship. And that can come from a quantitative standpoint or a qualitative aspect as well. So it helps keep the company's interests aligned with the banks to meet the company's needs. So scorecards can be very valuable to an organization, especially for organizations that have grown over a period of time and they get to a point where they realize, hey, I need to take a step back and look at my bank structure, my relationships, and figure out if I'm really optimized with the relationships I have in place today. Are there areas where I have gaps? Do I need to perhaps expand that wallet? Do I need to change the makeup of the wallet? So having a scorecard can help a company at least prioritize some of that.
That's a valuable perspective, Paul. Treasurers are advised to establish a bank relationship scorecard to make an accurate assessment of each bank and objectively communicate to them their positives and negatives for improvements and follow-ups. Speaking of communications, do you consider open and frequent communications or dialogue between a corporation's treasurer and its banks essential for supporting business continuity, growth, and profitability?
Yeah, communication is really important. I talked about earlier that treasurers often will have conversations with the bankers on a regular cadence, at least quarterly. They're probably talking to them at some level, perhaps more often when it comes to bank relationships that are a higher priority. So having that level of transparency with your bank, it's going to bond that relationship closer. It's also going to make that banker really want to work on your behalf to do the best they can for you. So it's part of that relationship management piece that can't be overlooked. You need to be as transparent as you possibly can without giving away non-public information. Obviously, you don't want to do that. But to the extent that you can share with your banker, what the initiatives are, what the goals are, what the organization wants to accomplish, not only within the next 12 months, but 3-5 years down the road. It helps the banker understand, I know where this relationship's going from today. And that will also open up more doors for those services, products, and credit that an organization needs.
Paul, banks have access to a multitude of clients and extensive industry information that leads into a wide range of advisory and payments security services that they can offer or that they may offer. My last question to you for today is, how should a corporate treasurer or treasury team leverage their bank's expertise?
That's a great question to close on because your banks do have a lot of expertise. The people that you work with, those organizations, have a breadth of knowledge. You'll find that a lot of your bank relationship managers have been with a bank or the bank that they're working for decades. It's quite common. They know what's going on out there. They talk to a lot of clients. They hear similar pain points, and they consistently work towards developing products and services that are going to meet those needs. So I think about banking services, fraud in particular nowadays. Banks have been more transparent in terms of what positive pay is or pay match positive pay, because companies can utilize this service and it will protect them from a payment perspective at a level that, will help prevent fraud. And fraud is it's more prevalent than perhaps it was 5-10 years ago, because the fraudsters are becoming more sophisticated. They're using technology against companies. A fraudster can be working 24/7. They can use tech to attack organizations even when they're sleeping. So, you have to have a partner that's going to have defenses to help you against those kinds of attacks. When it comes to credit, banks understand credit quite well. They know how to structure deals that will be appealing to organizations from an expense aspect and also from a liquidity aspect. And they are willing to partner with other banks when it comes to perhaps raising senior debt or putting together a revolver or credit facility. Oftentimes you have a consortium of banks that come together at various levels to offer credit. So they understand the needs of organizations quite well when it comes to liquidity management and access to capital. On the advisory services side, you should make sure that you're asking your bank questions every time you meet with them. And if you have something on your mind where you feel like maybe there's a gap or there's something you want to understand better, call them on the phone, send them an email, get in front of them. They will bring material to you. They will walk through it. They'll help you understand how things work. So on the advisory side, they can be a great partner for companies. Payment services, their ability to offer the types of payment services that companies need, whether it's traditional wires, ACHs, and checks, or looking at more instant payment platforms, especially with smaller banks that have access to FedNow. So, your real-time platform and your FedNow instant payment platform. And think about organizations that have a global footprint and the ability to do cross-border payments, foreign currency. They understand the regulations of different countries that they do business in. They adhere to the compliance of those particular areas, and they can be a good partner when it comes to the payment services, especially from a global perspective.
That's a powerful reminder, particularly the aspect on global footprints. Leveraging a bank's expertise does transform the relationship from transactional to strategic. Incisive insights, Paul. That brings us to the close of this episode. Paul, thank you so much for your thoughtful perspectives. And to our listeners, thank you for joining us. If you found this discussion helpful, we invite you to subscribe and share this episode with your network. We'll return soon with more meaningful conversations on the dynamic world of corporate treasury. Until then, stay informed and stay ahead.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.